content of this podcast is produced for entertainment purposes only and is for informational and educational use. It does not constitute financial or investment advice. You should not make any financial decisions based on the information provided without consulting a qualified professional. All opinions expressed are solely those of the host and guest and do not reflect the views of any company or organization. The hosts and/or guests may currently own, have previously owned, or intend to own securities discussed in the content. The content produced here belongs to Daniel Andreev of 18 Degree Journal and cannot be reproduced or used without prior permission. We do not wish for this content to be used for AI training and do not give such permissions. Hey everyone, thank you so much for joining us today and Merry Christmas. I really do appreciate every single one of you and also wishing you all very happy holidays. We have marathon productions this week, so keep an eye out on episodes coming in and out of your inbox. And today we're going to introduce a very special guest. You should be familiar with him if you've been reading our Substack. We did an early introduction with him earlier this fall. And he might have the double-edged curse or, double-edged sword of starting his fund in January of 2020. There we can kind of foreshadow that there's a lot of legendary investors that have started their investments during times of financial crisis. We have, I think Burry's a famous one. He started right before the dot-com bubble. There's a few others. So maybe this foreshadowing for greatness, but we'll know, only time will tell. So we want to welcome Whit Huguley. He had a prolific 5 years, and he's generating a double-digit returns for his investors. He started, as we mentioned before, on January 1st, 2020, his River Oaks Capital Fund. And he's focusing a main strategy on microcap specials, building his business on overlooked microcaps with A-plus management, boots on the ground approach, and a concentrated portfolio. So without further ado, Whit, welcome to the show.
Yeah, I really appreciate it, Daniel. And thanks for having me on. And I appreciate the write-up you did on me, earlier this year. If it's easiest, happy to give you my background or whatever you think is the best way to start off.
No, go ahead. The background's all yours, and thank you for making your, investment letters public. I think I learned as much as I got more out of the letters than I think you got out of my write-up.
No, I appreciate it. So I was born and raised here in New Orleans. That's where I am right now. I moved back home to start the fund, so a little before January 1st of 2020, I moved back home. I went to college for something completely different than finance. I worked for a startup company for about 5 years. And, was definitely fascinated in what it took to grow a business. I think I was employee number 3 or 4. And by the time I left, there was double-digit employees. And it was, a nicely growing business, which definitely fascinated me, how to grow a small business, what it takes, kind of the day-to-day activities that within growing the business. But it was pretty obvious to me that I needed more of a business acumen, financial background if I ever wanted to go down the route of starting my own company. And that's why I went back to get my MBA here in New Orleans at Tulane. I remember on the entrance exam or the entrance interview saying, I want to start my own startup company. That's, was the plan. And that's why I went back to school. And as fate would have it, one of the first courses I took when I was getting my MBA was an investment analysis course that pretty much solely focused on Warren Buffett, Ben Graham. We had to read The Intelligent Investor back here. And within 2 or 3 months of being back in school, I immediately pivoted to I want to be an investor, and this is what I want to do for the rest of my life. I know it's kind of like generic to say, but it really was like that inoculation that Warren Buffett talks about. It's like the second I read The Intelligent Investor, I was like, this makes perfect sense. In fact, in many ways, I've been living my life this way without even realizing it. And so from there, it was turned into a complete obsession. I think that first year of getting my MBA, I read 30 to 40 investment books. Many of them are behind me right now or on the ground over here. I just couldn't get enough of it. And I had never really been academically, I had never really been this fascinated in anything before. I'd never just felt I was excited to go to finance classes. I was excited to read books about all investing. It was something I never really experienced before. I'm very grateful I went back to school because I was able to find that. I guess fast forward a little bit, ended up getting my MBA, uh, got my CFA at the same time, and then moved out to California and worked in private equity, um, and worked for a company called AGR. And they're still around today. Great company based just outside of Sacramento. And, I didn't realize it at the time, but I was super fortunate in the opportunity that I walked into. Um, it was a large or fairly large private equity fund, but the deal team was pretty small. So I got to do anything and everything, and that meant going to visit management teams, going to going to conferences, talking to industry experts, going to visit competitors. I was traveling across the country, and I just got a tremendous amount of experience, and I really understood what it meant to be a business owner and the deep due diligence you have to do before you purchase a business, especially one on the private side where you can't just say, "Oh, I made a mistake. I'm going to sell it the next day." And so it really made me think in that prospective business owner mindset. The quote that I'll read it right now. The quote that Warren Buffett says that shares are not mere pieces of paper; they represent part ownership of a business. So when contemplating an investment, think like a prospective owner. And my time in private equity definitely made me think very much like a prospective owner. And also, it helped me understand the day to day operations within a business, that there's so much more to a business than the financial statements. There's so much more behind it. There's, the operations of the business, obviously, but just the day to day activities. The CFO's sick, the CTO is on vacation for 2 weeks, and something happens on the technical side. I mean, there's just each day there's things happening that are just not reflected within a quarterly report or a financial statement, and that really was I mean, looking back on it, it was just a tremendous learning opportunity. The second thing about the private equity firm that I got super lucky about, without even realizing it at the time, was that AGR has a bit of a different philosophy than most private equity firms. They'll go into a business which would be considered a micro cap or small cap business if it was publicly traded, and they'll buy 30% or 49% of the company. So a lot of the due diligence we were doing is very similar to the due diligence you would do before buying a public company as well, because we were not going into any of the companies at AGR on the private side. We weren't going into any of the companies that we were buying and doing what the stereotypical thing that people think private equity does is fire all the employees, bring in a new manager, all of that. We were partnering with the current management team. So it was very much the investment analysis side, and the due diligence was very much around the management team of that company, because that's who we were partnering with. And obviously that kind of perfectly translates into investing in public markets. So I guess fast forward to eventually, just missed home, wanted to go back to New Orleans, and also had always had, for whatever reason, had always had more of an interest in the public markets. it had always just fascinated me more than the private side. I can't even really say why, but it always had. It always caught my eye. And on the weekends and any time I had after work in private equity, which was not very often, I was investing family and friends' money. And I was just naturally attracted to micro cap and small cap public companies because that was the companies we were looking at on the private side would be the same size companies. And I was noticing that there was pricing inefficiencies in smaller private companies compared to larger private companies. Then when I started looking on the public side, I couldn't believe the some of the pricing inefficiencies that you could find. And obviously some of those are for good reason. Um, because I would say, let's say there's 3,000 companies that are publicly traded in the U.S. And I think if you include Canada, it's probably a little over 3,000 that under $1 billion of market cap. I mean, I think probably 95% of those companies are uninvestable for various reasons. Either they're super risky, they have a poor management team, they're trying to attack a market that's just simply too big for a small company to attack, just for various different reasons. So there is reasons why there is very low valuations within the micro cap and small cap public side, public equity side. But what I pretty much immediately realized, this was even before I launched the fund, is that the baby was getting thrown out with the bathwater. So that those 5% of companies that are wonderfully run businesses or have a great management team, kind of fit the checklist that I look for before investing in a company. They do exist. You just have to roll up your sleeves, get on the airplane, and go find them. They're not easy to find, but when you do find them, they can make really astronomical returns. So I guess that gets us to January 1st of 2020 when I launched River Oaks Capital, and happy to continue on from there. Or if you have any questions, whatever.
I want to pull a few strings, from a little bit earlier.
Yeah,
And I know you went to LSU and you think you did your undergrad in political science, unless I could be
yeah,
wrong. Do you
yeah.
think that experience in poli sci has helped you, at least some skill wise that you transferred over to, your business today? Because it is
Yeah.
a part of your foundation.
Yeah, that's a good question. I've actually never really thought about that. I mean, I could tell you what happened. I When I got to LSU, the suggestion I got was just major in whatever you find the most interesting, whatever courses you find the most interesting. And I found political science to be the most interesting by far at the time. I think it was, the second year in between my second and third year, I think. So in between my sophomore and junior year, I interned for a politician, and I was like, "This has nothing to do with political science. Like, I want nothing to do with this at all. It wasn't for me. I could see how it could be very fun, but it had very little political theory involved in it. Uh, so I actually ended up minoring in business after that because I just knew I didn't want to be in political science. I do think um, I've always really enjoyed politics and just like the thought process behind it. I mean, I remember being heavily involved in thinking about politics when I was in like fifth grade. It was very young when I was thinking about that. So I do think from a macroeconomic standpoint, it might help some, just like a deep thinking standpoint. But I can't say I use it in my day to day job right now. But it's kind of hard to say because it's always been a part of how I think. So maybe in some ways it does help. Um, I think it also helps you realize how complicated or complex systems are, and how unsure everyone is of what's going to happen next and how much uncertainty there is. Um, yeah, I think that's it. Probably helped in some ways, but there's nothing that helped more than going back and getting my MBA, and really just getting directed towards value investing and Warren Buffett and Ben Graham and that way of thinking.
But I know that after poli sci, you made another jump for the, as you said, to the food delivery. Maybe, but there you're actually in a small team. You're running the business. I'm sure you've got sales set from there. That, especially now when you're looking at smaller businesses, that you're like, maybe that's this kind of behavior. This kind of behavior. Yeah.
Yeah, yeah. That definitely. Now that I think back on it, that definitely helped. I was working for the founder, but I was like the third employee, I think, or third or fourth employee. Um, I was doing anything and everything. From, I mean, some days I was cooking in the kitchen, some days, but my main job was business development, which meant we were a food delivery company similar to like Blue Apron, but just locally here in New Orleans. So my main job was going out and finding customers, particularly large companies that were self-employed, because we were providing healthy food, and those companies were interested in their employees eating more healthily, to help their insurance program. So that was really my day-to-day job, was going there and trying to accumulate as many customers as possible. I think what I learned, and what was further reinforced in private equity is, like I was saying, that a business is so much deeper than the financial statements and the 10K and the 10Qs. There is just every day something pops up. There's some fire that needs to be put out. There's some new obstacle that gets in the way. It's not, it really is truly is a business that you are investing in. It's not a numbers balance sheet that you're investing in. It's a business, and you need what I call an A+ CEO to navigate the road of an ever evolving um, business environment.
So last question before we move on, to modern day. I think when you were doing your MBA, you were part, and again, I can mispronounce this horribly, but the Birkenroad
Yeah,
Club. And from
yeah,
what I know, it's an investment club from your school.
yeah,
So
yeah.
tell me about that experience, because I'm kind of curious. I don't think we have anything here, at least to my knowledge, at our school,
Yeah,
anything like that.
it's super unique actually. I don't know if there's many colleges in the US or throughout the world that had this. I got my MBA over 10 years ago, so maybe it's changed. But so what we did was, and it's funny because it's kind of probably planted the seed of what I'm doing now, is the professor went throughout the Southeast and picked what he called stocks under rocks, just very undiscovered companies throughout the Southeast of the U.S. And we were in teams of 4 as students, and we would write a research report on that company throughout the entire semester. And part of the research report was flying to the company and going to visit with the management team and asking them all these questions. And then at the end of the semester, there was a Birkenroad conference where all of the company's management teams would come to the conference, and outside investors would come to the conference, read our reports, but also ask management questions. So it was actually a really good way um, for these undiscovered companies within the southeast of U.S. And they were all small cap companies, all around 500 million market cap or below for the most part. And Yeah, it was super unique because it was very hands-on learning. Um, After that, I ended up helping teach the class my second year of getting my MBA, and now every year I speak to the class. I've developed a really close relationship with the professor of the class, Peter Raschuti, We probably go get coffee once a month and exchange ideas. And I speak to the class every semester, and then I speak at the conference as well. So it's been a really important program for me, and I've tried to help contribute now that I run my own fund that actually is very similar to the Birkin Roads, and actually it no longer exists, but the Birkin Roads did have a mutual fund that was publicly traded, and it did exceptionally well because they started covering this company, which is about 30 miles from New Orleans, called Corporation. And it started off as a small, even I think at one point it would probably be considered a micro cap company. And over 25 years, it was 20 or 25 years, it was the best performing stock in the entire U.S. So they go around to pools, clean up. It's like a roll up of uh, pool cleaners, but they also sell the products to help clean your pool. So the ticker symbol is POOL. I don't own it, but it's worth a case study of how a microcap can become a much larger than a microcap over a 20-year period.
Fascinating. Yeah, I had no idea, and I guess that's how you got your roots and kind of inspiration for where to go. I think then you went to AGR Partners, and the question, a lot of people go to private equity, they stay in private equity. And I
Yep.
know you said your pull to go to public markets. Is there any thoughts lingering that maybe you wanted to stay? Maybe that was better, or maybe even now when you have your fund as you grow in size, would you look at more private companies?
Yeah, I mean, it's interesting you said that. You say that because now that River Oaks Capital has grown in size, I definitely have had people reach out, seeing if I was interested in investing in a private company. So far, I haven't done that. If I were to do that, it would probably be through a special SPV. Um, but as of now, I'm just solely focused on publicly owned companies. I think there's a lot that to be said. There's going to be some changes, I think, going on here in the next 3 to 5 years, maybe even before that, because there's so much money in private equity, and in the micro cap and small cap world right now, um, unless you're somehow linked to AI or the technology boom that's going on, the valuations you're getting are just not good at all. A lot of the companies we own, I think, are trading at 50 cents on the dollar. So you're paying, let's say, $2 million. I think people debate on what the number is to be publicly listed, but let's just for to throw out a number, let's just say $2 million. Well, you're paying $2 million to be publicly listed, and if you're a couple $100 million microcap or small cap company, that's a significant cost. And if you're paying for a privilege to be publicly listed, but you can't use your share price as currency if you ever wanted to acquire another company, it's like what is the value of that $2 million? And obviously, if it's undervalued, you can buy back shares, whereas in private equity, it would be a little bit harder to buy back shares at such a deep discount. So there is that. But I think there is going to be some crossovers happening in between private equity and publicly microcap and small cap publicly traded companies. So I'm super interested to see what's happening. You're already seeing some of it happen in Canada and a few other countries, and it's slowly happening here in the U.S. But yeah, I think hopefully, and I have a feeling that my prior experience in private equity will actually start to play a role here in microcap and public cap or microcap and small cap publicly traded companies, as I think private equity probably will start encroaching on publicly traded companies. If I had to guess, it kind of makes a lot of sense.
No, it definitely makes sense to me, and I think your logic. I think I'm noticing exactly what you're saying, especially when you're looking at the very small companies. Sometimes you're buying not even in distressed companies, but companies on 10, 20 cents on the dollar. Something you definitely can't do with a company that's worth a couple $1 billion.
Yeah,
Uh,
yeah,
sp- Speaking of a couple $1 billion, I could be wrong because I was kind of researching. I know when you opened your fund in 2020, you can correct me if I'm wrong, but you owned companies that were a little bit bigger at the very start.
yeah.
And my question is first, why did you go big cap if you're all experienced at small cap? And would you ever look at a large cap if it if the numbers just made sense and you're like, wow, it should not be this cheap, even if it's even if it's trade, if it's such a big company.
Yeah, I think so. The first 6 months of starting the fund, I had, I basically what I did was I had investments that I was running for family and friends when I was working in private equity, like Berkshire Hathaway and a few other companies. And I just rolled them into the fund to start the fund. It was pretty immediate for me that, especially once I started traveling the US, I mean, so the second I started my fund, it was just in my DNA to, before we invested in a fund, to do the exact same due diligence that we did on the private equity side. So that meant getting on airplanes, going to visit the management team, talking to industry experts, talking to competitors, going to conferences, and it was a pretty immediate that I realized barely anyone, if anyone, was doing this for companies below $1 billion, and even it's even more drastic as you get smaller and smaller. I was showing up to companies I was interested in, and they'd be oftentimes they were like, "You're the first investor that's come here in 5 years in person." So, although in the beginning I owned a few large companies, I sold them pretty quickly because I realized that the purpose of starting a fund is to provide value to your investors, and I am also a large investor in the fund, and I did not think I could once I realized the inefficiencies in microcap and small cap, I was like, this is where I could truly provide value to my investors is by rolling up my sleeves and just traveling the country and getting to deeply understand companies that no one else is following. I couldn't realistically and in good faith tell my investors that I'm providing value to you by investing in Berkshire Hathaway or even Markel. I have no it, I have no advantage over a large hedge fund that has 50 employees working. They're flying drones over ships to see how much inventory is being shipped. I just had no advantage there, and so it was just it was pretty quickly that I realized that I need if I want to provide value to my investors, I need to solely focus on this one area of the market. I mean, maybe one day some opportunity is presented that's totally underpriced, but I have yet to. The watch list is longer, gets longer and longer. So, and for the micro cap and small cap companies, so I've yet to run out of ideas. That's just how I think of it. Is I'm gonna stay in the area that I think I can provide the most value to my investors, and hopefully they're interested. Um, or obviously the current investors are, but hopefully future investors are interested in the micro cap and small cap space because I feel like that's really one area. And obviously, take it with a grain of salt. I run a micro cap and small cap fund, but I really think that is one area where active investing can really set you apart because of what I originally spoke about. That probably 95% of microcap and the smaller end of small cap companies are uninvestable. So there's been many times where I've hopped on a plane, gone and visited a management team and been like, that is just a totally uninvestable company. It might be trading at 5 times earnings, it might be 50% of book value, but that money is never going to get returned to us investors. And so you can just, by being an active investor, you can weed out those 95% of companies that would otherwise be included in an index fund. Whereas when you get to larger companies, multi-billion-dollar companies, I think more of the debate is around valuation, and less of the debate is this an actual sustainable, like, is there, like, it's less around the quality of the business and more around the valuation. Like, there's probably not going to be a fraud, for lack of a better term, in a multi-billion-dollar company. Whereas if you travel the country and visit these smaller companies, you'll find companies that I won't say they're frauds, but they are run solely to provide the board their fees, the CEO their salary, and what happens with the excess free cash flow, they could care less. I don't think you find so much of that in larger companies. So, and I don't think you can discover that in smaller companies without visiting them in person. So that's just kind of, it took maybe 6 months to eventually get to that point after launching the fund, but it was pretty quickly that I realized I need to stay in this $1 billion market cap and below area.
Do you think that 1 billion will move? There's the joke of what is actually microcap anyway these days.
Yeah,
So what size are you looking at, and how do you think that will change?
yeah. I mean, yeah, it's funny you say that. It definitely got inflated after COVID, where just everything seemed to go up. It was weird to actually see from starting the fund slightly pre-COVID to now. You know, $1 billion would kind of be like in that we're not sure area. Now it seems to be kind of consensus considered micro cap. So yeah, it will be interesting to see what is considered microcap, or how. I guess the better way to phrase it is, it will be interesting to see how large of companies people stop paying attention to, because that's kind of what creates the inefficient, or that is what creates the inefficiency. Is any company below $1 billion, large investment funds, even super high net worth individuals are like, this isn't even worth my time. Family offices, they're like, this isn't even worth my time to look at. So that's what's created the opportunity. And that used to be probably $500 million market cap and below. Now it feels like it's $1 billion market cap and below. And eventually it could be $5 billion and below, where people just have completely given up on it, have stopped doing work on it. There's no sell side research on it. So that's what's creating the opportunity. And so yeah, it's more of how large of companies are people just going to stop paying attention to. I think it's probably the better question than how inflated will the definition of micro cap and small cap companies be.
Do you have a size of your fund to be in mind? Because obviously, if you get really big, these microcaps wouldn't really move the needle for you. It's just basic math. So do you have a range you're aiming for?
Yeah, I mean, the short term goal is to get to AUM to 50 million in the next year. And then I'll definitely pause there. I pause every time I raise capital, just to make sure I'm not affecting my previous investors. I don't want to get to a spot where I feel like I'm in any way harming the investors that initially took a chance on me before I even had a 6 months track record. Much less the 5 year or 6 year track record now. So I think the number where there kind of becomes a tipping point is probably around 100 to 150 million of AUM, and that might grow a little as what you talked about is more and more companies get underfollowed. But I think so. Around 100 million, I think, is where you can still buy 4 or 5% of the company, maybe a little more, without pushing up the price too much. And at the same time, And I can get into more of this as I've played more of a suggestivist investor role. The more of the company you own, the more you can influence the shareholder returns or the capital allocation decisions of the company. So I think there is kind of a happy medium of, if you're too small, you have no real influence over the company. You can obviously go into very unique areas. You could go into like the expert markets and some really small over the counter stuff when you're really small. If you get too big, you just simply cannot participate in microcap companies because you'll end up owning 15-20% of the company. And, it's that becomes a huge risk if you happen to get the entire thesis wrong. There's really no way out. Um, but there is a happy medium where you own enough to have sway over the company, but you're not too heavily concentrated or too large of an owner in that company. So that's kind of how I think about it, and that's why every time I raise capital, I pause, make sure I'm not crossing that tipping point. But I don't think, and from talking to other people, um, I don't think, I think 100, 150 million is probably that number um, that I've always had in mind.
You kind of front ran my question, but I'll circle back to it. I just had the joy of rereading Nick Sleep's letters, and he kind of touched upon the ethics of raising new capital. So
Yeah,
I'm gonna put emphasis on the part and how do you deal with the fact that you have the returns, coming in. You made, you're growing in size. So maybe when you were 5 million, if you made, 2% investment and that went up, say 100%, that was one return, and then you bring new people and you essentially dilute your returns for the original because the position is still, part of the portfolio, but not in the same manner. So how do you deal with that? Maybe in a sentence or two. I know you touched on it, but
yeah. If I'm understanding the question correctly, I mean, Nick Sleep's one of my favorite investors of all time. I've read through his letters multiple times. I think he's probably intentionally. I mean, he's kept quiet, and so he's. I think he's very underappreciated. But I think part of that is intentional. Um, but yeah, I mean, if the intention of starting River Oaks Capital was for me to make as much money as possible, I would not have I would not have focused on microcap and the smaller end of small cap companies. I would have invested in large companies, raised as much assets as I possibly could, and that would be the way to go about it. The intention was to deliver the best returns possible for my investors. And I thought that was, and I still do think that is through investing in micro cap and small cap companies because you can find such inefficiently priced, wonderful companies that you could end up getting your thesis completely wrong and you still get the current market cap back. I don't think that exists in larger companies for the most part. And I mean, I've always lived by Warren Buffett's philosophy is rule number one, don't lose money. And rule number two is don't forget rule number one. I always think about downside protection. And I think that is offered the most in micro cap and small cap companies. So yeah, I think there is a certain point where I believe Nick Sleep closed his fund and eventually I just stopped running it. But there is a certain point where you're doing a disservice to your investors by raising more capital. Um, and I think what he did was very clever and something I've also contemplated doing, or very favorable to his investors, is that the management part of his fees would come down as he raised more capital. I think that makes a lot of sense. Um, and yeah, I think everything he did made perfect sense, and you'll see that with a lot of other investors too, who are solely focused on returns. They'll just close their fund because they're saying the next dollar of capital that I raise is going to hurt I mean, my first investors were family and friends, and people I have Thanksgiving and holiday dinners with, and I'm looking out for all my investors. And so yes, there is definitely a certain size where you are diminishing your returns for sure.
So you kind of touched on a part about your suggestive actions that you, and I know I've read your letters that you sometimes suggest, for example, buying back stock, delisting, or maybe even uplisting as it becomes more favorable for the company. So we can touch on that, and also, maybe a little question within this phrase: would you ever sit on a board?
Yeah, yeah, good question. Good question. Yeah, so I guess to go back to, it was probably about year 2 or 3 of running the fund that I kind of had a aha moment. My first aha moment was roll up your sleeves, get on planes, and go visit companies that no one else is visiting. Um, and you might only find 2 or 3 investable companies a year, but those 2 or 3 are worth all the plane rides, because that plane ride home is so exciting when you're like, I just discovered a wonderful business that's trading at 50 cents on the dollar and no one else knows about it. I think the first one that I can really remember flying home from Dallas Fort Worth after meeting with Dayton Judd of FitLife, just being like, I just found an undiscovered gem, and that's really what I live for, is finding companies like that. Um, so it was probably about year 2 or 3 into running the fund that I realized that just because micro cap and the smaller end of small cap companies are mispriced. We bought FitLife at 5 times earnings. I think we bought ownership of FitLife at 5 times earnings, somewhere around there, and that's just Dayton Judd is the A++ CEO. But just because they're undervalued doesn't mean that a light switch is just going to come on one day and it's going to become fairly valued. So I realized it's my job to my investors to make sure we can do whatever is in our control, or in my control, of making sure this company becomes fairly valued. So there's a few different ways I think about it. I think if they want to buy back the first thing I do is convince them to buy back as many shares as possible. So first, let's capitalize on the fact that it is undervalued. We don't need to send the share price up to fair value immediately. Let's buy back as much stock as we can while it's discounted. You'll see a lot of management teams in microcap companies get very frustrated at the undervaluation of their company. They're like, I'm doing everything right. I'm running the company correctly. I'm doing presentations every quarter. I'm going to conferences, but we're still trading at 50 cents on the dollar. So my message early on was really, instead of getting upset about that, let's take advantage of how mispriced this company is. So that was almost always buying back shares. And then is that slowly? I would always go and visit. I felt that the message was much better delivered if I visited the management team in person, and I still do that. And we'll go with a 2 or 3 page slide. To give you an example, there was a company that was considering acquiring another company, and they were going to pay 10 to 15 times earnings. And I said, instead of acquiring another company, why don't you acquire more of your own company at 5 times earnings? And I think, just a simple explanation like that often clicks. Because what you'll find with a lot of these microcap and small cap management teams is they have so much weight on their shoulders. They have a very small team around them. So they're so just heavily focused on the operations and running the day-to-day operations of the business that they're not really thinking much about shareholder return. And that's not for all the companies we own. Some of the companies we own, when I fly to visit them once a year, or when I talk to them once a quarter, I just say, thank you for what you're doing. Keep doing everything you're doing. It's working great. So that was the first step of becoming what I call a suggestivist investor. The next step was recommending for some companies, I don't think it's for all companies, but for some companies to uplist onto the NASDAQ. if they're traded over the counter. I think you got to weigh the pros and cons of doing that. It obviously costs more to uplist, but I think a good example is go back and look at the chart of FitLife before they uplisted and after they uplisted. And the pros and cons you have to weigh is for FitLife, there was multiple investment firms that wanted to invest in FitLife. They had done all the research. They were staring at the company. They wanted to own the company so bad, but it was over the counter, and the investment firm had a mandate that they could only buy NASDAQ or NYSE traded companies. So you can watch it. The second that FitLife went from over the counter to Nasdaq, the share price immediately went up, and I think it's almost up 80 to 100% since they've done that. I might be slightly off of the numbers there, but it's quite a bit. So for a company like that, it makes a lot of sense because maybe you're paying $1 million more in fees, maybe $1.5 million. That number is highly debated, but let's just throw that number out. That makes a lot of sense. Whereas Truxton Trust, a company we own, they have a tight shareholder base. They generate a tremendous amount of free cash flow. It's just a beautifully run company, and they don't ever really need to raise any equity. And I've gone back and forth with them about whether it makes sense to uplist, and they feel that paying the lower fees is the right thing to do. They feel like saving $1 million or $2 million per year is actually the appropriate thing to do. So I've seen it, both sides of it make sense. And actually, I just had a company we own, old market capital delist from Nasdaq to the OTC. Most of the time, when you see that, there's heavy insider ownership and a tight shareholder base. So they're really just purely focused on free cash flow and just maximizing free cash flow. And not that FitLife wasn't, but FitLife was just constantly getting outreach from institutional investors, and they knew that there was huge demand for their stock if they were to uplist. And then kind of the third phase has been talking more and more with management teams about divesting non-core assets, getting rid of selling businesses that really are not within their core competency. I think the reason a lot of this has become more and more successful, and not every company I talk to listens to my feedback and implements it. But it's been a lot higher percentage than I ever expected. I think a lot of this has come from the long-term mindset of our fund. A lot of the companies we owned, we bought 5 or 6 years ago. So I've visited with these management teams 5, 6, 7 times in person. I've talked to them 20 to 25 times in person, and have developed a really nice relationship with them. So they know that the suggestions that I'm giving are not suggestions that are meant to boost the share price really quickly so I can sell. It's because I think this is what's the best for the company and the shareholders of the company over the next 5, 10, 15 years. And then, so to go to your last point, is kind of where I'm looking at 2026, 2027, is despite all that work, and I'm still pitching every company to buy back shares and do all the things I just mentioned, I still think almost every company we own is undervalued. So I think what that means is I need to roll up my sleeves even more and get more actively involved in the companies we own. And I think that's going to involve, I want to be on a few boards this year and next year, and whether that's myself being on the board or finding someone to represent River Oaks Capital that makes more, that they would provide more value on the board than I would. I think um, something that I think is really interesting, and you can see it from a company we own called Ascent Industries. What they do in their presentation is they clearly position themselves. They say, here's our earnings before public company costs, and here's our earnings after public company costs. So what they're showing in all their presentations is here's our value to a strategic or to a private equity firm. And I think that's really what every company should start doing in the microcap space is you don't have to sell the company this year. You don't have to sell the company in 5 years. You don't even have to sell the company in 10 years, but at least put the option on the table of selling the company and letting it be known that when the time is right, we are open to selling the company if the price is appropriate, and positioning yourself to strategics and private equity firms to show the value within the company that would be created if you sold to them. I think it makes a lot of sense. I don't see the downside in doing it. You obviously have to align with the proper companies because you need a lot of insider ownership. You need the CEO to own quite a bit of stock because let's say his or her salary is $400,000, $500,000 a year or somewhere around there, but they own 0% of the stock. They would have no interest in selling the company. They would much rather just collect their salary. So you have to make sure that you're positioning you're positioning yourself with um, the right type of company, and that's all. That's a checklist that has to be checked off, anyways. For me, there has to be high insider ownership. But I think that's really an area, and I'm not saying I'm going on the board to pitch that, but I just think you need share buybacks as an option. You need potentially uplisting the option. And I think you need potentially selling the company or selling a piece of the company or selling to a strategic or private equity as an option. It doesn't have to be an option now. If you feel like the earnings of the company are going to be way higher in 3 years, then by all means wait for 3 years or wait for 5 years. But I don't see any downside that I can think of at least making that one of the options for getting to fair value.
No, that sounds fair, and I'll keep watching over that journey. And if I
Yeah,
see your name on the bullshit, I know what to look for.
yeah,
Before we move on to the next section, I want to circle back. You have a lot of experience, and I think you build your fund on this aspect of meeting management and having these talks. And you mentioned that you sometimes see green flags and red flags. And sometimes what do you watch for to know that if the management are with you, other than of course them being shareholders or not? And what are some other green flags other than share inside ownership that you're like, yes, this is what I need on my team?
yeah. Yeah, that's a really good question. I got really lucky or fortunate early on to meet Dayton Judd, the CEO of FitLife. We own shares in FitLife, by the way. And I met him, I think, within the first year of running the fund. And so I sat down with Dayton, and it was very different than any other CEO I had met prior to that. And the reason it was so different is he spoke to me business owner to business owner. So he said, "Here's what the company does well. We're great at acquiring companies at discounted costs. We're great at cutting costs. We're a few other things, but we could really use an update to our ERP system. We could use more bench strength." So he listed out the pros and cons of the business. So he was talking to me, one business owner to another business owner, and that's what we both were. He owns way more of the business than I do. He owns, I think, 40%. At the time, I probably owned 1%. Um, but he was speaking to me business owner to business owner and not sugarcoating the areas of the company that needed work. Every company has flaws, and that's even more so for smaller companies. So to try to pretend like you'll go to a lot of conferences and you'll speak to a lot of management teams, and they say there's nothing wrong with our company. We are perfectly run. We're going to be the next Apple. We're going to, we're going to 100 times our stock. And it's like the way I think about it is, there's a lot of restaurants here in New Orleans. If I was to buy a 10% ownership in a restaurant here in New Orleans, and I met with the management team, and they said, "Yeah, there's zero things wrong with the restaurant. Everything's run perfectly well. Every employee is perfect. We're all the margins on everything we sell is perfect. All every it's a flawless business." I was just like, that you're not telling me the truth. Like, um, what I want to hear is sitting down business to business owner. Yeah, we have a great general manager. We probably don't charge enough for these certain items. We could use an update to the bar. Just highlighting the pros and cons of the business. So that's what I really look for is when they sit down. Obviously, there's an immediate checklist of just are they capable, honest, do they have high integrity, those types of things. But after that, it's are they speaking to you, business owner to business owner, and you would be amazed at how few CEOs in the micro cap and small cap space actually do that. And so they really stick out like a sore thumb when they do. So it's refreshing whenever you meet them, but it's few and far between. And I could dive into why I think that's so important to have an A plus CEO. I think an A plus CEO in smaller companies is even more important than in larger companies. I think in one of my letters I wrote, the importance of the management team is disproportional or inversely proportional to the size of the company, just meaning the smaller the company, the more important the management team is. And I think that's for a few reasons. A, the management team is probably running the entire business. They don't really have a support staff. I think the other reason it's super important to find an A plus CEO is most likely if they're in a small niche industry, um, that there's not any other A plus CEOs in that industry. Most of the other CEOs are C or D CEOs. So when you plug someone like Dayton Judd into a niche nutritional brands industry, he's just going to run circles around his competition. So he's going to organically gain market share. He's going to acquire companies that he himself has probably put into distress by outperforming them so much, or the company's just put on too much debt. So it's like a professional player playing against a high school player. It's like the company almost doesn't even really need a moat. It's the moat itself is the A plus CEO. So that was probably a really long-winded answer to your question, but yeah,
No, I think it's very informative, and I think not only in a micro cap business, but even in a large cap, if the management says everything is perfect, you should run.
yeah, exactly, yeah, yeah,
Um,
yeah,
so before moving on to some of your more central ideas, I know you own two different types of kind of like categories of businesses that you buy. You buy some for, well, I'll rename them because I don't remember the right term, so forgive me. You own like the compounders that you want to hold for a long time, that they're growing their business modes. And then you own those that at excessive discount. And I know that for microcaps, you said that, moat doesn't really exist. You kind of have these isolated islands, and you
yeah.
just hope that the businesses can grow in those islands. So how do you determine when to sell, and how do you find this different than when you're looking at large caps, especially in those two categories?
Yeah, that's a good question. Yeah, so the two segments I break it into are wonderful businesses and excessive discounts. Um, and I mean, to be honest with you, I would love a portfolio of 15 wonderful businesses. Um, and I think right now it's about 10 wonderful businesses, 5 excessive discounts. It's just they're few and far between in the micro cap and small cap world. And so I'm always actively, what I'm really actively searching for is wonderful businesses with A plus CEOs. What happens along the way is every now and then I run into a company that is well run. They like a community bank, for example. They don't have a moat necessarily. They're not really in a niche industry. There's tons of community banks, but they're so undervalued that it would be a disservice to my investors to just say, well, we only invest in wonderful companies, so I'm just going to overlook this company. A company we own, Citizens Bank, has more cash in the holding company than the market cap. So it's like, okay, yes, technically, a community bank wouldn't be considered a wonderful business. I think it can be a very solid business, but it is so deeply discounted. And the management team there is great. Cynthia Day, who's run the company for, I believe, 20 years. Um, yeah, right at 20 years, I believe. And I mean, she is a wonderful CEO. Um, so there's nothing wrong with the business. I just don't think there's any moat of or any uniqueness to it. It's just so undervalued that it would be a disservice to my investors to ignore. Whereas the companies I'm really looking for are A plus CEOs that are running what I call they're running niche, off the radar small businesses. And I don't think, at least I can't think of any small cap or micro cap or small cap businesses that have a true moat. Let's say you have a unique soda company that's a micro cap business. I don't think there's anything you could possibly do to protect that company from Coca-Cola coming in. They just have so much cash that they could, if they wanted to, they could outcompete you. What makes it interesting is if you find a niche off the radar industry, it's small enough where the major companies aren't attracted to it because it wouldn't really move their revenue much. But there's plenty of room for that small company to grow into, let's say it's a $300 million market cap company. There's plenty of room for it to grow into over $1 billion company. So I call it the remote island mode, where it's just so far off the beaten path that it would not make sense for any major competitor to sail over to that island and try to conquer it. So like it wouldn't make any sense for a major competitor to invest R&D in marketing to try to penetrate the market. They either will just leave them alone and let them make 15 to 20% return on capital for multiple years, or they'll go and acquire the business at an extreme premium. So that's really the companies that I'm solely focused on finding, but along the way, I do come across excessive discounts, and I'm not just going to ignore them just because they're not wonderful businesses. Because it's the downside protection on some of these excessive discounts is just astronomical. And I don't think you can find many of those in larger companies. So I forget what the second part of your question was, but I was rambling on there for a while.
No. I was just saying, how do you know when to sell, especially, as like excessive discount gets to full value, if a compounder gets to, say, extreme value? You mentioned that sometimes in microspace, it's very hard to know from price movements what's actually happening with the stock because you have, a forced seller, price tanks. You could have the same thing. Maybe a company's buying a lot, it just drives the price up. So how do you navigate that, and how do you know when to actually sell?
Yeah, that's a super good question. And I think that's why traveling the country and doing so much due diligence has helped so much, or helps so much. Is if you visit a company once a year, talk to the management team once a quarter, do in-depth research. In each one of my letters, I try to write at least a page, most of the time 2 pages on each company, and what's happened to them over the last 6 months. If you're doing that much work, you probably understand the business better than 99.9% of the investors um, for micro cap and small cap companies. So when the share price goes down, um, it almost always, or I shouldn't say it almost always, but it often presents an opportunity to lower your cost basis. Because I've been involved in many companies where the share price has gone down 20%, 15% in one day, and it's just because someone closed their fund, or there was a divorce and one side of the family decided to sell their shares. And I'll call up the CEO and he'll tell me everything he's allowed to tell me, saying that most of the time they're like, yeah, nothing material has changed within the company. We haven't released the press release. We haven't issued a guidance release. Isn't something within our industry that's changed. It's just gone down 15% because there's not a lot of volume and there's a forced seller. So it can really prevent. I don't know any other area of any market in the U.S., private or public, where you can be presented an opportunity to lower your cost basis by 15 to 20% on when the business itself is not impacted in any way. Almost always, when you're buying at a lower stock price, it means something has happened within the business. And in these companies, oftentimes it's totally unrelated to the business. I guess to answer your original question, I think about it two different ways. For an excessive discount, once it's 85 to 90% fairly valued, I'm very inclined to sell it, unless along the way, as I've gotten to deeply understand the business, I actually consider it a business that's worth holding on to because I like how well it's run. I think Citizens Bank would be an example of that, because I've gotten to know them better, or I've gotten to know them really well over the last, I think it's been 4 years now. Um, Even once it becomes close around fairly valued, I would still heavily consider continuing to own the business. I really like how they think about banking, how conservative they are, in that area. For a wonderful business, really, there's only three reasons I would ever sell. One is I've misjudged the management team, and they're either unethical, just incapable of running the company, or the business strategy has just gone awry. Mostly the unethical part. If I ever sense that I've misjudged the ethics of the management team, I'll sell on day one. The second reason would be that the share price gets so far ahead of itself, or the valuation gets so far ahead of itself, that it would be a disservice to my investors not to sell. We've really only run into that problem during COVID, when one of the companies we own got meme stocked, or whatever you want to call it, where all of a sudden it was trading at 50 times earnings. It's like, I am a long-term investor at heart, but at some point you have to say, okay, this would take 10 years of 20% return on equity to grow into this valuation. I think it makes sense to sell this company and reinvest it somewhere else. And then the third reason would be if they just had a complete right-hand turn on their investment strategy. So to go back to the analogy of owning a restaurant here in New Orleans, if one day I wake up and they say, actually, we're going to start building water parks, that would be the third reason I would sell. So other than that, I plan on holding the businesses for 5, 10, 15, 20 years.
Sounds great. So we're going to pivot quickly to our last topic of the day. And I do want to say a shout out to everybody who's interested in a lot of stuff you wrote and about Citizen Bank and other community banks. You have excellent investment letters on your website. So I do suggest listeners to go check that out. But today, if you don't mind,
Yeah,
jump a bit into your forestry and lumber industry, lumber mill thesis. I myself had a lot of fun, probably over the last 2.5 months, reading a lot about lumber and looking at a lot of Canadian lumber mills, especially now with all the tariff, we'll call them attacks.
yeah,
So you own, I think, Green Forest, I think it is,
green forest. Yeah.
and I think they own 4 lumber mills in Ontario. And yeah, can you talk a little bit what your original thesis is and what you think about the current state?
Yeah,
Because
I mean that one's been a very interesting investment. It's not a huge position in our portfolio or in our fund, but I guess it was around 2021. Um, Paul Rivette, who used to be the president of Fairfax, he obviously left Fairfax and started basically an investment company. And one of his investments was Green First, where they bought the assets. They bought at the time 6 lumber mills and a few other obscure assets from, I believe the company was called Rayonier. And if you recall, during 2021, and I think 2022, the price of lumber just went through the roof. Um, so, like most commodities, when something like that happens, when there's a huge up, there's going to be a huge down. Um, we could go into the various reasons why lumber skyrocketed like that, but so at first it looked like it was going to be a great investment, and I'm not saying it still isn't, but lumber finally normalized, and it's at this point it's probably about break even. Last I checked, but what Paul and his team have done on the capital allocation side has been simply amazing. Um, they sold the 2 lumber mills in Quebec. Um, they divested all their non-core assets. They owned a bunch of land. They had an overfunded pension plan where they took all the cash out of the pension plan. They paid down a vast majority of their debt, renegotiating the debt. I'm missing more stuff that they've done, but it was basically the only reason the major lumber companies in Canada, Interfor, um, West Fraser, all the large Canadian lumber companies weren't interested originally in the Rayonier asset that Paul and his team bought, was because there was all these obscure assets linked to it. They also owned like I think it was like 180 acres. I might be off on the acreage, but just that had nothing to do with land, with timber, and they sold that as well. So they are now down to a 4 lumber mill company, and they also, part of the original deal was buying a paper mill as well, and they've spun off that paper mill into a separate business and got some government funding for that paper mill. So on the capital allocation side, you couldn't ask more out of the team. They've done everything they could do in their power. Unfortunately, while they've been doing this, the price of lumber has done nothing, and it's break even at best. I think what's super interesting. There's 2 things that aren't talked about. The super interesting thing is the 4 lumber mills they own are in Ontario, and I'm not an expert in Canada, but from my understanding, Ontario is the most business friendly province, right? Of all the provinces, and it's where the major lumber um, companies want to be. So those 4 lumber mills, and they're also quite low cost lumber mills as well. So those 4 lumber mills are very attractive assets to a strategic acquirer or to a larger Canadian company. But they could also be very profitable just running them on by themselves as a 4 lumber mill company. I think the other part that's getting missed is the duties. Um, so each year, Canadian companies have to pay a certain amount of duties per year to the U.S. but it's a weird dynamic. They actually just put it in a bank account, for lack of a better word. The money doesn't it isn't gone, and so every 10 years or so, the U.S. and Canada get together and negotiate how much of those duties they should return to the Canadian companies and how much actually stays in the U.S. So I think like a fair estimate is a conservative estimate will be 50% of the duties are returned. So if you kind of do the math, and I haven't done it recently, but I think the duties return could be more than the current market cap of Green First. I'd have to go back and check that math because they actually sold the right to some of their duties. Um, but I think what makes that even more interesting is once the duties are returned, the major players in the industry, Interfor, who already owns quite a large percentage of Green First and is clearly interested in buying Green First, will be flushed with cash when the duties are returned. So, it's not my thesis, and it's not the way I like to think about investing. That this company is very attractive to be acquired. I think that they when lumber normalizes, or I guess a better way to put it is when housing demand increases, which will then increase the price of lumber. And it should increase quite a bit because you're finding the high cost producers, lumber mills, are closing down because they just can't keep up. They can't remain profitable at these current prices. It's just a typical commodity cycle, right? Um, and So once they do get slightly higher, I think the four lumber mills could generate a 20 to 25% free cash flow on the current valuation of Green First, maybe even a little higher. So it's a nice optionality that could be acquired, but I think it could easily generate just as good, an excellent return as a standalone company. You just have to sit and have the patience for this cycle to turn. But I think when it does turn, it's going to meaningfully turn because there's been a lot of capacity that's been taken off board, especially over the last year. So that's how I think about it. Really like Paul Rivette. Really like how he thinks about capital allocation, and I really like how swiftly he has divested of non-core assets and just done all the things. There's things I'm missing that you can look in my letter that are there. But he's done. They've worked tremendously hard over the last, I believe it's 4 years.
So the reason I kind of brought it up, to me, kind of stood out that I know when you bought the banking assets, you had this headwind of the government loan, especially when the banking crisis happened in the States, I think 2 or 3 years ago. And now you're having this, again, here you might have government loans. I think government of Canada commissioned maybe $700 million as short-term loans. And then there's, of course, the duties. But the reason it brought my attention to, I know a lot of investors are now worried about, well, the added new tariff, I think 10%. So a lot of the tariffs went from 35% to 45%. And
Yeah,
on January 1st, I think secondary wood products are getting a 50%, so from 25% tariff to 50% tariff.
yeah.
So a lot of these mills are losing money, and I don't know if that scares you. Is there something you're watching for? Is there like something that, yeah, if this keeps going, it might change your thesis?
Yeah, I mean, it's certainly not helpful in the short term by any means to have a tax on the product you're selling, or an increased tax. I think um, what needs to happen and what will hopefully happen, obviously, the Canadian lumber mills are getting some support from the government. But I think what really the truth behind it is I just don't think there's enough lumber in the U.S. to meet the needs of the eventual houses that have to be built within the U.S. So, um, you're going to have to import it from Canada, and I don't see the sustainability of putting a tariff and kind of just like headbutting with Canada this much. So, I mean, don't get me wrong, by no means does it help what's going on right now, but I just don't see the long term sustainability of it. But I could certainly be wrong. I think even if I was wrong, it's so undervalued right now that I don't think I think just by getting the duties back in the underfunded pension plan, we might already be at the current market cap. So
And last question before I want to respect your time. So before we move on to the closing, I know that Trump recently enacted especially for lumber, backward taxes. So the duty you mentioned before, I think a lot of companies had to put up more collateral,
yeah,
for the future duties, and a lot of them are cash constrained. Does that scare you in the short term? Because like it or not, cash is king. And
yeah,
if a lot more of these backward taxes start getting enacted, legal or not, because I know it's going to the Supreme Court next year, does that put a little more gray, or maybe a little more scuttlebutt percentage of what your margin of safety should be on these businesses?
yeah. I mean, I think the main lesson learned here is it's probably the only commodity company I've ever invested in. It's by I'm so far from a commodity expert. It's just so cheap. It was one of those companies that's so cheap that I couldn't ignore it. So it's at a valuation that's so low right now where my entire thesis could be wrong, and I think we could get more than the market cap back. So when I was originally investing in it, I was not investing saying, "Oh, I think lumber prices are going to be this price." I was not thinking of it as a commodity investor. I was thinking of we have a great capital allocator in Paul Rivette. It's extremely undervalued. It's now even more undervalued. And even in the worst case scenario, which um, you know is would be lumber being below break even for a long time, I think we would still get the current market cap back. So I mean, I think, but to go back to that kind of danced around the question you asked. To go back to your question, they're going to have to come to the table and figure this out. We just don't have enough lumber supply, as far as I know, in the U.S. to meet the housing shortage that we have right now. So, if you go back to, I think it was like 2003, 2004, somewhere around there, a very similar thing happened, and then they eventually figured out a way to, make up and shake hands and figure out how to cooperate together. So yeah, we'll see what happens. That's certainly part of the reason why the company's so undervalued right now. But I think there's just a few really missing pieces that people are overlooking within the company. But yeah, it's the one commodity and company that I've invested in. I can't say I'm eager to go out and invest in other commodity companies because it seems like it's one thing after the next when it comes to commodities.
Well, thank you for sustaining my curiosity there. So before we let you go, last question. It's your fifth year running the fund. You started during COVID. It's now, going into your sixth year. What have you learned? What are your takeaways? What would you have done differently if you restarted today?
Yeah, yeah. So at the end of the year, I'll have run the company for 6 years. So I guess that's or run the fund for 6 years. I guess that's a week from now. Yeah, I think so. Before fees, I think we ended up doing about 11% a year, somewhere around there, maybe slightly higher. After fees, a little above 10%. I think if I would have gone back from the initial beginning of running the company and rolled up my sleeves and got more involved with the companies we own, or sorry, since running the fund and then getting more involved with the companies we own, I think that return could have been 13 to 15% per year, just by giving suggestions on returning capital to shareholders. I probably would have strayed away from companies that weren't um, open to suggestions or shareholder return friendly. But so I think about that a lot, and I will, as I said, roll my sleeves up even more in the next 2 years, even starting right now. Um, but I think the number one, if I had to say, here's the number one lesson learned, and I think I wrote about this in my last letter, it's find the A+ CEOs. It's travel the country, do everything you can to find the few and far between A+ CEOs that there are. A lot of times they're not very promotional. They're not the ones going to the conferences. So you have to go out and find them yourself. And it's not really something you could do as a retail investor. I think it's something you can only do if you're a full-time investor. And that's really, I mean, if I go back and look over the last 6 years, what our best investments have been, the one common link has been there's been an A+ CEO running the company. And that was when I started the fund, I had more of a Buffett type mindset, and by no means, and I still have very much a Warren Buffett type mindset, but he kind of says, invest in a company that any idiot could run because one day they will. And I think that's very applicable to companies in the multi-billion-dollar market cap. I think if you put a C- CEO into a microcap company, I don't see it working out. I don't I'm sure sure there's examples out there that would prove me wrong, but that's been the biggest lesson learned is travel the country, go find the few and far between A+ CEOs that are out there, buy the company at a margin of safety so that if you end up being wrong on your analysis of the CEO or your analysis of the business, you can still get the current market cap back, which is an opportunities that are being presented left and right now in the micro cap space. Yeah, that is definitely the biggest lesson I've learned for sure.
Well, thank you, Whit. I think a lot of us learned a lot from this, and I think I personally have taken a lot from your letters and from this talk. The last thing we collect from every person, I guess we have, is what book currently you're reading. Any recommendations? I can throw one right now. I'm currently reading The Fairfax Way, so would definitely recommend it. I think it came out last month, something like that. So would rather read.
Yeah, I just downloaded. It's called Deep Work by Cal Newport. I haven't read a page yet, but I've had too many people tell me what to read it. I think one of the underrated books that people don't talk about a lot, just because I think it's really well written, is Against the Gods by Peter Bernstein. I read it quite a while ago, but it's most financial books can be tough reads. If you've ever tried to read security analysis, I think you'll know what I'm talking about. This is a very well written book, and it really makes you think about risk and projecting into the future. And that's the first book that pops into my mind whenever someone asks for a suggestion, because I can go through the obvious suggestions, Seth Klarman's and Warren Buffett's and Graham and all that, but this book was one that really I really enjoyed.
Well, thank you. I don't think I've read it yet, so I'll definitely add it to my list. And
Yeah,
if I have questions,
check it out. It's a really easy read.
So how would guests find more about you? Do you want to, plug your Twitter, maybe your website?
Yeah, Twitter is just my name, Whit Huguley, Whit Huguley. But probably the best way to find me is the website riveroaks-capital.com. And you'll find all my letters, returns, one-pagers, podcast interviews. I try to put anything and everything on there. So I think that's the best way to find me. And if you're looking to reach out about anything, my email address is on there, or you can fill out a form that will send your email address to my email address, and I can reach out. So.
Perfect. Thank you so much, Whit. You're always welcome back. We hope to keep learning from your progress, and we'll keep monitoring you. So we're not stalking. We're just trying to keep in touch.
No, I appreciate it so much. This has been fun.
Thank you so much, Whit.
Thank you.